Very good morning, viewers. Thank you for joining us today. We have with us Mr. Ashish Ranawade, who heads products at Emkay Wealth, and we are looking forward for his views on the markets. Very good morning, Ashish.
Good morning.
So, Ashish, year 2022 was all about US markets taking a beating and everyone globally looking at India as a stable economy. That was 22. What will be your views on the Indian markets while we get into the new financial year?
Okay. So, to summarize my view on the equity markets, I would say we are positive. And this positivity is coming from the fact that India is going to be the fastest growing economy in the world. And that essentially decides the global sentiments as far as the Indian markets are concerned. And there are two things which matter when it comes to equity markets performance. One is the flows and second is the earnings, right? So we feel that given this background and given how resilient India has been in the fact, given that the US has been increasing rates, inflation has been raging across the world in the last 1 year, the oil markets have been on a boil. The Russia-Ukraine situation has not, been resolved so far, and it's probably going to continue into the new year as well. Given how resilient India has been, and given how the government has been pushing, whether with the PLI schemes or whether with the expenditure on infrastructure, on defense, modernization, the Make in India initiative coupled with, defense. All of these initiatives are going to help, the economy and, resulting in positive earnings for companies. And, given this background, I feel that the overall sentiment for the markets are also going to be positive, and it is the sentiments which are going to decide the flows. So the way I look at it, even though on a relative valuation basis India is expensive, there is a reason why it's expensive, and going forward earnings and flows are also going to be positive. So I would expect good double-digit returns on the Indian equity markets going forward.
So what I hear, Ashish, is that the pointers are very encouraging, but at the same time, the Indian markets do look a little bit expensive. Keeping this scenario in mind, what products would you suggest to the investors to look at?
Okay, so when I look at the equity markets, the first thing which hits me is that the US markets are down, and there are many US tech stocks which are down more than 40-50% over the last 1 year. And I see a huge opportunity in investors who have the ability to go and pick in the US markets to actually do that. So there's great value there, because end of the day, growth is going to come back when the Fed stops raising interest rates. And I think that will happen in the next 6 months. And when that happens, the US markets are going to come back with a bang. And that's, that's the nature of the US economy. That's how it functions. So my first bet would be, for investors to look at global stocks through so MK has provided a platform to our investors to invest directly in the US stocks. We also have various funds now which invest in, of course, given the regulatory situation, some are open for investment, some are closed, but the ETFs are always open. Yeah. So, I would say that would be the first decision I would say I would want the investors to make. Right. And overall, even from a portfolio perspective, I would say 20 to 25% of an investor's equity portfolio should be US stocks, because number one, that's where technology exists. The cutting edge technology companies go and list themselves on the NASDAQ or in the US markets. So whatever is happening in technology in the world, that's going to be available on the NASDAQ. Right. And second is in terms of the market capitalization, some of these companies, like even product companies, Apple, Tesla, these are all listed on the US markets, and these are real large caps, larger than the Indian large caps, right? So from that perspective, also it gives a strength to the core of your equity portfolio.
Right.
So that's one area which I would look at. And second is, within India, there are a lot of value stocks, because typically what happens when interest rates are rising, stocks get beaten down, and when things ease out, it's these stocks which start performing well. And if you see, PSU banks have been doing well. I mean, PSU banks were classic value stocks, right? So till the time growth comes back, I think value is going to perform. So Indian investors wanting to invest in the Indian market should look at value stocks. And there would be select small caps and mid caps, which are, again, I would look for value more than growth at this point in time, because I think next 6 months, relatively, and growth stocks are expensive in this market. So given that situation, I would say look for opportunities there.
Makes sense. Taking you slightly away, from the mainstream stock market, what would be your views on real estate and REITs in particular?
Okay, now this is a very difficult sector to take a view on. Very, very cyclical. Very, very dependent on local factors. Very, very dependent on interest rates. But given the demographic profile of this country, and given the typical migration which happens to the cities, I would look positively at real estate. And also the government has been doing its bit. Recently, Maharashtra government has indicated that they would want to give SOPs in the form of reducing stamp duties and those kind of SOPs to the real estate sector. So I would say neutral, not extremely positive at this point in time. And as far as REITs are concerned, REITs, again, the relative yield again depends on interest rates. And in a rising interest rate scenario, the valuation on REITs ideally should get a slight correction. So not very positive on REITs at this point in time. Would wait for the interest rate scenario to come down. Stabilize.
Okay. And our viewers, I'm sure, would like to know your views on a new asset class which was on standby for a very long time, which is gold. Your 2 bits on gold, please.
So gold has surprised us. We were expecting that with inflation going through the roof in the United States, gold ideally should be a best. Historically it's been a good hedge against inflation, but unfortunately gold has not moved this time. And my sense of gold demand comes from primarily central banks buying gold and retail investors buying gold. And looks like retail investors buy gold, A, for investment and B, for consumption, right? Now looks like, given the huge massive flows which have been coming into the equity markets through in the form of SIPs, which is typically retail, my sense is people are looking at alternative means of investments. So the investment demand for gold has gone down, and given the huge inflation scenario, gold consumption demand also seems to have plateaued. Central banks are not again stashing up on gold reserves. So I think all of these factors have resulted in gold being flattish, and I think it's nothing dramatic is going to happen in the next I would say 6 months to 1 year, which will change this situation so much that gold will start functioning. So I would say typically 5 to 7% of an investor's portfolio should be in gold, and it can continue to be at that level.
Right. Thank you so much, Ashish, for your views. They were very valuable, and I'm sure our viewers will also find them very valuable. Thank you.